According to reports, more than 90% of Iran's oil exports now end up in Chinese ports. These refineries aren't state-directed, and they do operate largely outside the influence of Beijing's national energy companies. To protect their profit margin, they began buying Iranian oil en masse starting in 2022 because it is sold at a discount. It is very attractive. At one point in 2023, Iranian crude was actually selling for an average of $11 less per barrel than comparable non-sanctioned oil from countries like Qatar or Oman. Even in 2024, that discount averaged about $4. Of course, now, amid fears of Israeli-Iranian escalation, which is certainly coming from what it appears, the discount has narrowed to just $2. For these Chinese refineries, this discount has increased their profit margin. It made them more profitable. It enabled them to collect more. But it comes with a catch, of course. There is a certain level of dependency. Iran accepts payments in Chinese renminbi instead of US dollars, of course, because it is under US sanctions. And so that actually limits its options on how to spend its earnings. Almost inevitably, that money that it receives from oil sales to China, that money actually flows right back into Chinese goods and services. This feedback loop has deepened Iran's economic reliance on China, and now China in turn gains significant leverage as it maintains its role as Iran's top trade partner.